In this video, we're going to talk about investment diversification. So how do you set up your investments to avoid any unexpected risks so you can generate profits in a really safe way? So let's get started. If we look at a mutual fund, you can compare a mutual fund with a basket. So many people are investing in this mutual fund. Here is any, let's say, ETF, then you don't have management. And if you have a mutual fund, then you have any management here, which is managing your investments, or let's say managing the mutual fund itself. So now this mutual funds invests on average in, let's say, 80 to 120 different companies. So let's say this mutual fund is investing in Coca-Cola, which is in the USA, and let's say consumer goods, soft drinks as an industry. On top of that, this mutual fund is investing in Samsung, which is in South Korea. And they are in, let's say, top technology. And then they are investing in Daimler, so Germany, and cars. Now, how does diversification work? If Coca-Cola is selling less bottles of Sprite, is Samsung selling less hardware? No. If Daimler is selling less cars, is Coca-Cola selling less soft drinks? No. Which means they are not correlating. And this is the key of understanding investment diversification. Your investments shouldn't correlate too much, because otherwise you have a so-called cluster risk. So let's say you invest in Apple, you invest in Amazon, then you invest in Meta, and you invest in Alphabet. What is your risk now? So you have 4 single stocks, but in the past they worked really well. But now you are only invested in the US, which means you're fully relying on the political situation, on the economic situation, on the social situation. You're only invested in dollars, so you're fully relying on one currency, and you're investing only in one industry. So you're also fully relying on that industry. If you now invest over 5 years, might be the case that you lose money. And then you might say, yeah, investments are risky and investments are not working. But if you diversify your portfolio, and I'm not saying, don't get me wrong, don't invest in these companies. You should invest in these companies. But you shouldn't only invest in these kind of companies because you understand them better or you have a better connection to this industry or something like this. So you should definitely pick a mutual fund or an ETF which is investing globally. So let's say you would like to invest in long term and you would like to create a portfolio, and then you choose the MSCI World ETF. Because you should invest globally, so MSCI World is an ETF from BlackRock, invests globally. Yeah, but typically in the MSCI World ETF, you have 60% US. And this is also a cluster risk because 60% is too much. We typically say it obviously depends on your risk appetite, your preferences, and so on. But 15 to 20, maybe 25% should be invested in one sector. Regarding the US, you can invest more than 15 to, well, let's do it correctly, 15 to 25%. So in the US, you can invest, let's say, 40%, because obviously US is the biggest economy, I have huge profits there, so it's okay to invest 40% in the US market, but you should avoid to invest significantly more. Now I guess you understand the key of a portfolio diversification. Now it comes in place. We have to diversify regarding industry, countries, continents, currencies. So let's just call it countries. And we have different currencies. This is how you diversify a good portfolio. So please be really careful. Not too much into one industry, not too much into one country. We have many clients, they were only invested in one country. We also have many clients from India, because in India there are high interest rates. So I totally get this point of investing some money there. But please be careful. We never know what happens geopolitically, what happens with any unrest regarding neighboring countries. We have seen that in China. We see that in China now, because we had many Chinese clients also. We have many Chinese clients also, and they invested a lot only in China. And they are now really happy that we moved some money from the Chinese market also into the global markets, and they were also outperforming regarding the growth rates the whole world. And this is something which happens also in India right now. And this might cause issues long term, as we already see in China. And it might be the case that the same happens to India. Not for sure, but if we invest money, we always think about probabilities. And the probability that you have higher profits long term with a diversified portfolio in comparison to just betting on one country or one industry is significantly higher. So if you would like to have help to set up a good investment strategy and a good investment portfolio that works for you long term in a safe manner, then reach out, click on the link for the homepage, register for a free initial consultation, and we will see what's the best investment strategy in your case.